Verizon Communications is rising in price, so should you be buying into this company? Well, over the past year, the company is up by almost 24%, but over the past 5 years, they are down by 27.5%, which might mean that the company is undervalued compared to where they were about 4 to 5 years ago. And to figure this out, we'll simply jump over to our fully automatic stock valuation spreadsheet, where we will plug in the ticker VZ for Verizon Communications, and all the metrics will show up automatically. Now what we will do in these sheets is we'll figure out Verizon Communications intrinsic value using our 4 valuation methods, and we will also analyze its fundamental historical values to see how well the company is doing internally and how well they are set to do in the future. Now, jumping back to our stock screener, we can see that over the past year, the company is indeed up by quite a bit. Now, Verizon Communications does have a dividend yield of 6.42%, which is a very sweet dividend yield, and the dividend payout is currently sitting at $2.66. Now, the company does have a trailing free cash flow payout ratio of 56.56%, which is quite a decent free cash flow payout ratio. Now, the reason why I'm using the trailing free cash flow payout ratio and not the normal payout ratio is that every company pays its dividends out from its free cash flow. So using this metric, I get a much better idea whether the company has enough free cash flow to, for example, raise their dividends or buy back shares. And that's why this metric is so important, because when it's too high, it means that the company won't have enough free cash flow to develop their business and therefore might have issues in the near future. Now, the earnings date of Verizon Communications is on October 22nd, which is about 2 months from now, and the beta of the company is sitting rather low at only 0.41, which means that it's much more volatile than the S&P 500. But now we want to jump to the 9-pillar analysis. And right away we can see that the 5-year PE ratio is sitting very low, which means that the company is trading at a low price compared to their earnings. This is the same case with the price to free cash flow ratio over the past 5 years. It's sitting at 9.20. We want it to be sitting below 20. And again, this means that compared to their free cash flow, the company is very, very cheap at this current time. Now, two metrics that I'm not liking that much are the increasing shares outstanding and the long-term liabilities of the 5-year free cash flow. We can see that Verizon Communications are currently selling out shares, which I think is a very bad step as they are trading at a fairly low price, so they should buy back as much shares as possible. And this is something linked to the free cash flow payout ratio. When the free cash flow payout ratio would be lower, they would have more free cash flow to buy back more shares and therefore have a better stability into the future. Now, the second metric is the long-term liabilities over the 5-year free cash flow, negative dividends, and I'd like this to be sitting below 3. Now, for Verizon Communications, this is sitting at 5, which means that the company would be able to pay off their long-term liabilities in about 25 years. Now, what this means is that they don't generate nearly as much free cash flow as they would need to pay off their long-term liabilities while paying out their current dividend, which means that they might have issues with debt into the far future. Now, scrolling down to the graphs, we can see that the gross profit margin of Verizon Communications has been slightly increasing over the past few years, which is always nice to see. And the PE ratio is indeed sitting quite low over the past 5 years. So as I said, the company is trading quite cheap. Now, otherwise, the revenue has been rising very slightly. The net income has been decreasing over the past 5 years, and the free cash flow has been decreasing as well. So that is something to look out for with Verizon. Now, the shares outstanding are increasing slightly. I already mentioned my concerns with that. The long-term liabilities are increasing as well. Now, this is something I really don't like. The long-term liabilities are increasing, the free cash flow is decreasing, the shares outstanding are increasing, and the quarterly dividend is increasing as well. So this means that the company pays much more free cash flow every year while they get more and more into debt. So that is again something I really don't like Verizon Communications for. Now, the earnings per share isn't really stable. As we can see, it's decreasing actually over the past 5 years, and the free cash flow per share has been decreasing as well. So overall, Verizon Communications wouldn't be my first pick when investing into a company. But now let's try evaluating its intrinsic value using our 4 valuation models. So first we'll jump to the Grams formula. And here, using the Grams formula, we'll take the earnings per share, the base PE sitting at 7, the 5-year growth estimate, the growth rate multiplier, the yield on A corporation bonds, and the average yield on A corporation bonds, and get an intrinsic value of about $41, which is 1% lower than the current trading price, showing us that Verizon Communications is fairly valued at this current time compared to their earnings per share. Now, in our discounted cash flow analysis, we'll take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at about 5%. Now, the analysts don't project a high growth rate at all. They project about 2.33% growth rate every single year over the next 5 years. And I will project a low growth rate as well, a growth rate of about 2%. Now, using this growth rate, I will calculate the future free cash flow and then plugging in discount rate at 7%, as I do want the company to return a higher value. I will calculate the present value of that future free cash flow. I will then sum all of that up and add any cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get a price per share, an intrinsic value of about $60 per share, which is $20 higher than the current trading price. Now, normally we would jump to the multiples valuation model, but as I really believe that Verizon Communications only compares to TNT, we will skip the multiples valuation model and arrive straight to the dividend discount model. And here we'll take again the dividend growth rate over the past 5 years and calculate the average growth rate to be sitting at 3.36%. Now, as I do believe that Verizon Communications will have to cut their dividend increases as they have been doing over the past 3 years, I will plug in a growth rate of only 2.4%, and that will give us an intrinsic value of about $60. Now, moving to our ultimate valuation, we will average out the 4 valuations and get an ultimate intrinsic value of $53.34, which is about 30% higher than the current trading price. And if I plug in a margin of safety of 20%, I get an acceptable buy price at $42.67, which is still a little higher than the current trading price, showing us that buying Verizon Communications at its current price might be quite safe. Though taking into account the 9-pair analysis we did, I think that the margin of safety should be a little higher, say 25%, and if I plug that in, the acceptable buy price would be sitting at $40. That would mean about $1.50 lower than the current trading price. Now, over the past year, Verizon has been trading at much lower values than it currently is sitting at, and I do believe that it will go slightly lower than it currently is. So if you are looking at buying Verizon Communications, wait a bit longer until it drops slightly lower than its current trading price. Now, if you did enjoy these sheets, if you find them helpful, again, make sure to check out my Patreon. Make sure to leave a like and subscribe, as it really helps me out. Thanks for watching.